Good morning, everyone. Welcome to a conversation with John Williams, President and CEO of the Federal Reserve Bank of New York, hosted by the Guarini Institute at New Jersey City University. It is a pleasure to have President Williams with us today talking about very important topics from economic outlook to monetary policy, as well as the regional economy here in New Jersey. I must remind everyone that we are recording this event and that the recording will be available in our website later on, as well as in other social media channels. To kick off this event, I want to introduce the president of New Jersey City University, Dr. Sue Henderson. Sue.
Adrian, thank you so much. Good morning. I'm Sue Henderson, president of New Jersey City University, and on behalf of NJCU and our entire NJCU community and the Guarini Institute for International Education and Economic Mobility, I'd like to welcome you to today's program. This is a conversation with John C. Williams, president and CEO of the Federal Reserve of New York. When the Guarini Institute was launched in November of 2020, today's vitally important conversation was exactly what we envisioned as part of the wide-ranging scope. I want to thank Dr. Adrian Franco, the Executive Director of the Guarini Institute, for his leadership in spearheading today's program. Under his direction, we're building the Guarini Institute into a flourishing thought leader, which continues to serve as a conduit to advance economic development, deepen and grow academic partnerships, and spur personal development. Today's program continues to connect the dots between big picture thinking and the hands-on grassroots work our Guarini Institute is doing. As we continue to advance the mission of the Guarini Institute, understanding what's happening in the economy and the national arena is significant. We are honored to be joined today by President John C. Williams, and thank him so much for taking the time today to make this conversation a highlight of his 2 days engagement with leaders in government, business, education, and community development throughout northern New Jersey. In President Williams' role as President and Chief Executive Officer of the Federal Reserve Bank of New York, he also serves as the Vice Chairman and a permanent member of the Federal Open Market Committee. It's these roles with the Federal Reserve and with the FOMC that make these conversations both vital to President Williams and a chance for all of us to grow. We understand the importance of topics such as economic growth and inflation in our everyday news cycle as our nation continues its recovery from the virus-induced slump of 2020. Therefore, the remarks that President Williams will make today on the U.S. economy, monetary policy, and the economic outlook for the northern New Jersey region are ones that, given the current national headlines on inflation, are particularly timely. To our audience watching this event, wherever you may be, I encourage you to think, listen, and learn, because these conversations matter. I'm particularly thankful that President Williams' willingness to engage in a question and answer session later in our program with our faculty and our students. As Benjamin Franklin once said, "Tell me and I'll forget. Teach me and I may remember, but involve me and I learn." Prior to his current leadership role from 2011 to 2018, President Williams was the President and Chief Executive Officer of the Federal Reserve Bank of San Francisco. Before that, he was the Executive Vice President and Director of Research at the San Francisco Fed, which he joined in 2002. But he began his career in 1994 as an economist at the Board of Governors of the Federal Reserve System. In addition, President Williams is a well-known economic scholar before he became a top leader for the Federal Reserve. He served as a senior economist in the White House Council on Economic Affairs and as a lecturer at Stanford University's Graduate School of Business. The tie between academia and economics is an important one because so many of our leading economists have spent considerable amount of time on college campuses, focusing on teaching and research. With his roots firmly planted in academia, President Williams enjoys speaking with faculty and students, and I'm certain you will find today's discussion extraordinary. It's important to note that the conversations that President Williams has with those of us in academia, along with business leaders, community leaders, and public sector, also help his decision-making. These data points complement the statistics he receives and helps inform his decisions. So please know that our students and our audience are not the only ones learning today. These conversations matter. President Williams holds a PhD in economics from Stanford University, an MS degree from the London School of Economics, and an AB from Cal Berkeley. Following President Williams' opening remarks, we will be joined by Dr. Bernie McSherry, the founding dean of the NJCU School of Business. Before joining the NJCU family in July 2014, Dean McSherry spent 33 years as a Wall Street veteran and as a business leader and entrepreneur and former governor of the New York Stock Exchange. I cannot think of anyone better to moderate our session. At this time, I'm privileged to introduce Mr. John C. Williams to begin today's discussion.
Well, thank you. Good morning, everyone. I want to thank Sue Henderson for that kind introduction, and I completely agree with everything you said about the importance of learning and teaching the academic world and the world of policy making. I also want to thank New Jersey City University for hosting today's discussion. As you mentioned, I really enjoy speaking with students and faculty members. I look forward to the time, hopefully soon, when we can have these types of events in person. Today, our virtual setting is Jersey City, so it's one of the most diverse cities in the world, and also one known for terrific pizza. Now, it's not my place to get into the debate over who has the best pizza, and I've learned that people have very strong views on that subject in this region. And as president of the New York Fed, I proudly represent both sides of the Hudson River, and my job is to make the economy stronger and the financial system more stable for all. Now, before I move on from the topic of pizza to economics, I should give the standard Fed disclaimer that the views I express today are mine alone. They do not necessarily reflect those of the Federal Open Market Committee, or what we call the FOMC, or others in the Federal Reserve System. As you well know, the economy, like many facets of our lives, continues to be shaped by the unpredictable nature of the coronavirus. As I've said before, the pandemic is first and foremost a health crisis. And while Omicron was milder for many, and thankfully, the wave has subsided relatively quickly, it still caused terrible hardship for countless families. Now, you can see the economic effects of the pandemic right here in New Jersey. And what struck me this week, as I met with New Jersey business, community, and political leaders, was the different ways that COVID-19 affects local economies. So if you look just a few miles from Jersey City at Port Newark and Port Elizabeth, they're humming with activity. But across the Turnpike, Newark Liberty International Airport has seen a big reduction in the number of flights and passengers relative to pre-pandemic trends. And likewise, the pandemic has led to empty office buildings and fewer travelers to New York City, and that affects businesses here in New Jersey as well. So today, I'm going to talk about how the economy has continued to recover, despite the many disruptions and imbalances that COVID-19 has caused. I'll also discuss the labor market and the rise in inflation. Then I'll describe how the Federal Reserve's monetary policy is working to help restore balance and stability to the economy during these uncertain times. Now, since it's the Friday before holiday weekend, I won't test any of you on the functions of the Federal Reserve System, but I do want to take a moment to discuss the Fed's dual mandate of promoting maximum employment and price stability. U.S. monetary policy is set by the FOMC, which is made up of the Board of Governors and 5 of the 12 presidents of the Federal Reserve Banks. And we make our decisions after studying the data, lots and lots and lots of data. And we look at everything from food and gas prices to retail sales and inventories, from labor costs and employment figures to semiconductor inventories and shipping expenses, and from the demand for goods and services to readings on public health. And we consider more than just numbers on spreadsheets and charts. We also regularly hear from business and community leaders who tell us firsthand what's happening in the economy. And this occurs both through our regular meetings with our boards of directors and our advisory groups, as well as in ongoing discussions with local leaders. And that's why it's so important for me to make trips like this one, even if it's just virtually, so I can meet with leaders to hear their perspectives. For example, earlier this morning, I spoke with officials at the Port Newark Elizabeth Marine Terminal about supply chains and logistics, and it was a fascinating conversation about a really important topic in our economy today. And yesterday, I met with groups in North Jersey who are working to bridge the gap in health outcomes and housing, 2 critically important issues that can affect economic mobility. So despite the disruptions from COVID-19, the overall economy has shown remarkable strength and resilience over the past year. To put this in perspective, the onset of the pandemic in 2020 caused the sharpest US economic contraction since World War II. And since then, we've seen a remarkable turnaround. The economy, measured by real gross domestic product, or GDP, grew about 5.5% over the course of last year. And that would be the fastest pace of growth since 1984. Now, to get an idea about how long ago that was, 1984 was the year I finished college. So the labor market has also improved dramatically. It is now very strong. Over the past 12 months through January, the economy added over 6.5 million jobs. The unemployment rate has fallen from the pandemic peak of 14.7% to just 4% today. In fact, there are many more job openings now than there are people looking for work. And another clear sign of the hot labor market is that wages rose sharply last year, especially for lower paid jobs. Now, I mentioned earlier that the Federal Reserve has two goals: maximum employment and price stability. And the very strong labor market is great news in terms of achieving maximum employment. However, we have seen inflation rise to a level that's far too high. 10 years ago, the FOMC set a longer run goal of 2% inflation. That means prices that rise 2% per year on average. And from 2012 through 2020, inflation averaged below this 2% goal. But the inflation rate started rising sharply in 2021, and the Fed's preferred price measure, which is the Personal Consumption Expenditures, or PCE price index, rose 5.75% last year. And that's the highest reading since the early 1980s. This sudden, sharp rise in prices reflects a unique set of circumstances that has driven supply and demand out of balance. For those of you who've studied economics, you're not going to be surprised that I ascribe the rise in inflation to demand outpacing supply. But the rapidly changing situation of the past few years, and especially last year, has been truly extraordinary, and it's worth discussing in some detail. After the onset of the pandemic, Americans shifted their spending from services to goods. That's spending less on restaurants, vacations, and entertainment, and more on things like cars, appliances, and furniture. And as businesses tried to meet the surge in demand for goods, distribution channels backed up, supply chain bottlenecks and shortages appeared both here and abroad. Too many ships arrived at the ports, and particularly those in California, and when the ships were finally able to dock, there weren't enough workers and drivers to unload and transport goods to stores or to people's homes. In addition, we've seen a large pullback in the number of people willing and able to work, in part reflecting the challenges and risks of working during the pandemic. And some businesses can't hire people fast enough to meet the strong demand. And this has contributed to the acceleration in wages I mentioned and higher prices for a variety of goods and services, including food and housing. And high inflation is hardest on those already struggling to make ends meet. So this brings me to the outlook for the economy and monetary policy. As I said earlier, demand for goods and some services is now far outstripping supply, resulting in elevated inflation. With the labor market already very strong, it's important to restore the balance between supply and demand and bring inflation down. A number of factors should help accomplish this rebalancing, and monetary policy has an important role to play. First, with the Omicron wave now ebbing, and COVID vaccines and treatments much more widely available across the globe, we should see a gradual restoration of supply and a resolution of associated bottlenecks and shortages. Over time, consumers should also start to cut back on buying goods that are in short supply and switch back to in-person activities like travel, dining, and entertainment, where supply is less constrained overall. Together, these developments should contribute to more balance between supply and demand in the economy. The second factor is fiscal policy, which provided a huge boost to the economy during the past 2 years, but is unlikely to be as significant a source of demand this year. And this is true not only for the United States, but also for many other economies. It's a point I just should reinforce all the time that COVID has been a global phenomenon, and a lot of these issues are not just unique to the United States, but truly global in nature. Last, but definitely not least, is monetary policy. After providing maximum support to the economy for the first year and a half of the pandemic, the FOMC is adjusting the stance of monetary policy with the aim of bringing demand in balance with supply, and thereby bringing down inflationary pressures. The same is true for many other central banks around the world, which either already have moved in this direction or are expected to this year. Now, the initial step in that process was the FOMC's decision to first reduce and then end its net purchases of Treasury and mortgage-backed securities. So these purchases, they pushed down longer-term interest rates, making it less costly for consumers and businesses to borrow, and contributed to favorable overall financial conditions that supported spending. Now, the next step will be to raise the FOMC's target range for the federal funds rate, and that's the short-term interest rate at which banks lend to each other. In March of 2020, the FOMC reduced the target range for the federal funds rate by 1.5 percentage points to near zero. And this very low interest rate contributed to the sharp rebound in demand which propelled the strong labor market recovery that we saw last year. But with today's strong economy and inflation that's well above our 2% longer run goal, it is time to start the process of steadily moving the target range back to more normal levels. In particular, I expect it will be appropriate to raise the target range for the federal funds rate at our upcoming meeting in March. Now, once the interest rate increases are underway, the next step will be to start the process of steadily and predictably reducing our holdings of Treasury and mortgage-backed securities, which had grown significantly as a result of the purchases that began back in March of 2020. Now, last month, the FOMC released a set of principles that will guide that process. And assuming the economy develops roughly as I expect, I foresee this process getting started later this year. So taken together, these two sets of actions, steadily raising the target range for the federal funds rate and steadily bringing down our securities holdings, should help bring demand closer to supply. In fact, even though we haven't actually done either of these things yet, financial conditions have already responded based on the expectation of Fed policy, Fed action. For example, medium and longer term Treasury yields and fixed rate mortgage rates have risen back close to the levels they were at back in December 2019, before the pandemic. Of course, our actions will be driven by the data and a determination to achieve our maximum employment and price stability goals. So again, I go back to these three factors that are working together to restore balance between supply and demand. And I'm confident that we will achieve a sustained, strong economy and inflation at our 2% longer run goal. For this year, I look forward to continued growth and receding inflation, both for the nation and North Jersey. Specifically, my forecast for the US economy is for real GDP to grow a bit below 3% this year, for the unemployment rate to end the year around 3.5%, and for the PCE price inflation to drop back to around 3% before falling further next year as the supply issues continue to recede. Now, since the onset of the pandemic 2 years ago, this has been an extraordinary time for the economy and for monetary policy. As we work to help restore balance to the economy and bring down inflation, our actions will always be driven by the data, and we will remain focused on achieving maximum employment and price stability. Thank you.
Thank you, John. Thank you for those remarks, and it's really great to have you here. Thank you for taking time to speak to our faculty and our students and our staff. So just to kick it off, you mentioned earlier, the importance of coming to New Jersey, and we have a Jersey-centric audience here, I suspect. What is it about New Jersey that's special? What do you feel in terms of how we're doing in recovering from the pandemic? We were hit very hard early on, but we seem to be bouncing back a bit. What are your views on New Jersey and the economy?
Well, first of all, I should say, the New York Fed is not just New York. The second Federal Reserve District is New York, northern New Jersey, and western Connecticut and Puerto Rico and U.S. Virgin Islands. So it's definitely part of the district that we focus and study carefully. So, the purpose, if you will, of the visit yesterday and today is to add to our knowledge that we already have from all the data, the economists, the analysts that we have studying what's happening in our region and in throughout the district and throughout the country. And really, given the fast changing, circumstances we've all been seeing during the pandemic, is hearing how people, how people see things today, especially with Omicron ebbing, and where they see the challenges and opportunities going forward. So it's really to get that firsthand viewpoint from a lot of stakeholders in the region. So what did I hear? So I heard what you already said, which is New Jersey was hit harder, as we know, early on, as was the whole New York area during the pandemics of early 2020, but has been, have very strong recovery. I think that the economy is benefiting, from the strong national economy. Clearly, we have the manufacturing sector here. The ports and aspects of that are really booming. So you're seeing a lot of good recovery, like you've seen in the rest of the country. I would say one factor that's still not fully recovered is really closely associated with New York City, so across the river. And that is a lot of people still haven't come back to the office. A lot of people are working remotely or working mostly from home. And with that, a lot of businesses who rely on that flow of people, either through transportation or restaurants or theater or whatever it is, those activities have kind of been replaced with people sitting at home making their own dinners and watching TV, streaming something on TV. So I think, especially in some of the service sectors and in those areas, not only New York still not fully recovered, but that has spilled over into the northern New Jersey area. Now, my hope is, and expectation is hopefully with the pandemic, kind of resolving maybe and turning more endemic standing as people come back to the office in whatever that new normal is, the new hybrid work environment that many of us are going to, those sectors will also pick up. It's similarly like with the airport, with people willingness to travel internationally.
Yeah, here in Jersey City, the parking garage that I'm in is starting to fill up a little bit more than it has been. So we're seeing some signs of life. We've got lots of students on here, and they're trying to think about their futures and where they might want to go. What are some of the opportunities you see for the region here in New Jersey as we get through this pandemic?
Well, I think that this region has the strengths that have served it very well, and those will continue to be true. I do believe that the post-pandemic economy will in many ways be very similar to the pre-pandemic economy. Clearly, financial services is a big employer in northern New Jersey and in New York. Obviously, technology is becoming a sector that's becoming larger and more important in this region, along with other areas of science and things like that. But obviously, the arts and entertainment are also very important for the region, and also unique. I mean, if you think about people who live remotely, and everyone's had to do what they could do to get through this situation. But if you live far away from places like New York or cities like that, you don't have that firsthand kind of experience with a lot of the things that we get to have. And I know we've all missed that for the last 2 years, for most of the last 2 years. But I think that the attractions that make New York and New Jersey really, in 2019, the thing that we were worried about is how can we handle all the people coming here and the cost of living here. So I think that a lot of this is could be in the STEM areas, but also much more. I always would include the arts and in the creative arts in that too.
So we have a number of students and faculty who are anxious to talk to you a little bit. So if we can open this up. I hope our moderators can bring in our students. Our first student is Devin Echavarria, and he has a question for you. Let's see if you can get him on here.
Hi, President John Williams. Thank you for joining us today. So my question had to do with the debate that has erupted about the implications of raising interest rates in order to deal with this inflationary moment that you mentioned. How do you think raising interest rates will affect these financial markets, and is there some caution at the Fed about how to approach these raising interest rates without damaging jobs and wages?
Well, you cut to the chase, to the core of the issue around monetary policy today. So that's a great question, Devin. Thank you for that. So I do think that although inflation is way too high right now, as I said in my remarks, there are some reasons for optimism for inflation to come down, but it does require an important part of that is for monetary policy to move from a situation that we put in place about 2 years ago to give maximum support to get the economy back on its feet, to get more of a position for monetary policy to give stability to the economy, get supply and demand more in balance. And that really does mean higher interest rates over time. So how do we do that to make sure that we, as you asked, that we don't create huge disruption in financial markets, and importantly, we don't cause too much cause weakness in the economy, because we have our maximum employment goal and we have a strong economy today, a strong labor market today. So we want to preserve that. I think it's exactly what we're trying to achieve, and I'm confident we can achieve. On the first, I think the key thing is the transparency, the communication of monetary policy. We're not doing things unpredictably or abruptly, or things. We're really trying to explain our plans, our thinking, our strategy, and then how we execute that. Of course, we have to make the decision that makes sense at the time and get the right decisions. But a big part of the work is laying out our approach. For example, on the balance sheet reduction that I mentioned, we put out these principles. First of all, we're explaining, here's the principles that are going to guide this as we move forward in time. We'll talk more about the specifics of what that is. And eventually, there's a decision about timing and action. But I think what really helps in the modern world is being as clear and transparent as possible. And obviously, if the situation changes, you have to change your decisions. But again, try to do that, communicate that well. I think we've had good luck so far. I mean, the last couple of months, financial conditions and expectations of Fed policy, quasi policy of central banks in other countries has moved pretty significantly in the last couple of months since December, and that happened in a pretty orderly way, even with all the uncertainty about Omicron and other events. So I think we just have to stick to a very transparent, as predictable as possible approach, and continue with that. On making sure that we keep an eye on the keeping this economy strong. I do think we are fundamentally in a very good place. Labor market is strong, job openings are high, so we're in a good place for that. So it's really kind of, maybe if you thought about taking some of the heat off that's what's causing the inflation, rather than trying to weaken the economy from where it is. So that my expectation is that we can manage, if you will, the soft landing. We often talk about monetary policy, which means keeping the economy basically in a strong place and and growing, but just trying to restore more of the kind of, if you will, balance and stability in terms of where demand is relative to supply. And of course, I have to say, the supply issues and these demand issues, they're going to change over time too. So you have to be nimble and adjust to that. But you've identified the two hardest parts of my job in monetary policy, and this is how we're thinking about it. I think it's really about having a good plan, a strategy, and then executing that, and being willing, able, and to adjust as the circumstances change. That's what we've been doing in the last few years, and I think that's served us well.
Thank you, John. That was a very good question, David. I know that students are, especially those who are looking to graduate this year, are very keenly interested in how the job market's looking going forward. So thank you for those remarks. We have another student here, Musli Low, and she's going to ask us a question as well.
Hello, Dr. Williams. Thank you again for taking the time to speak with us. You made some really interesting points, especially about the supply chain issues and how they were caused by changes in consumer behavior during the pandemic. So with that in mind, since you're expecting it to recede around 2023, how do you think the upcoming monetary policy in March and in 2022 will interact with those supply chain disruptions?
Well, okay, I'm gonna sound like a broken record pretty soon. Another terrific question, right? That is really touches upon an important issue. I mean, I think the way I think about this is, there's a lot of uncertainty about the supply chain issues, more generally uncertainty about the inflation outlook and the economic outlook. There has been since the pandemic started, and we have to just recognize and acknowledge that. And so the way I think about this is that, you have a baseline view. And I kind of laid out my baseline view in my prepared remarks. And this is how I expect things to play out. You watch the data, you talk, you analyze all the macro data, and obviously we do a lot of analysis with our economists. You talk to people in the businesses to try to get that better understanding, and then and just update your beliefs about, like, is this data confirming what I expected? If it isn't, how do I think about it now? So my baseline outlook is that the supply chain issues will gradually recede, and that will take some of the inflationary pressure off that side and help aggregate supply to get closer to demand. That's part of the story. And from a monetary policy point of view, that would inform kind of my thinking for the near term about what we need to do in monetary policy. That's part of that outlook. But importantly, as the year progresses, and obviously getting into the next year as well, we're going to get more information on that and get a better understanding of, is that really happening? Is it happening a little faster than we expected? Is it taking longer? And then, you can think about adjusting there. In my view, starting the process of raising interest rates off essentially zero makes sense in pretty much any of the, doing that in March makes sense pretty much in any of the cases I'm thinking about. It's more of a question of what do we need to do, whether later this year or next year will depend quite a bit about how, those issues actually resolve. I mean, the surprise, to be completely frank, of last year was that COVID waves just kept coming. The supply chain issues, which were receding in certain areas, popped up in other areas, and they intensified. I think in large part because COVID just kept coming back in bigger and bigger waves. Fortunately, I think the medical vaccines and treatments, and they're helping us deal with that. But still, they have a big effects on the economy. So again, we have to make plans, operate under a lot of uncertainty, and then adjust course appropriately.
Thank you, mostly. I'd like to next introduce Dr. Andrew Bossi. He is the chairman of our economics department, and Ann and I both share a keen interest in economic and financial history, so I'm looking forward to his questions. Andy.
Hi, Dr. Williams. So now that I have the sort of ear of a Fed president, I got to ask this question. Has the New York Fed considered using more of its seniorage to make what I have to assume is a vast and unique, and I mean, even in terms of the regional Fed, the regional Feds, the vast and unique historical archives more readily available online? Again, either of its own initiative or in partner with the St. Louis Fed, who's really, shown real leadership in this. I have to say, as someone whose research has depended very heavily on the St. Louis Fed's Fraser, the public and free availability of data and the archival data that, again, the massive archival data that you have has been one of the great public services that the Fed has performed, and I would really encourage more of it.
Well, first of all, thank you for that comment, and I completely agree with the premise that we do have a lot of fascinating history here and a lot of fascinating information that's important for historians, and we do work hard when historians or economic historians or economists want to study archival information to provide that. It's true that we don't provide it all on the internet because it often depends on what the specific requests are. And I've been reading histories of the Fed for various reasons during the pandemic just to understand how people 100 years ago or 50 years ago dealt with different situations. And clearly these archives are valuable for thinking, understanding the past. So we obviously support that. But you kind of went right to where I was going to go, which is Fraser at the St. Louis Fed, and obviously we are a very some big supporter of that effort and provide a lot of archival information for that. And I guess my takeaway from your question is we need to continue to think about how we can support that kind of research and analysis in the future in a way that is cost effective and to do that. So it's a good conversation to have, continue to have. I will say that we also have a lot of information, this isn't really to your question, but to on monetary policy and the Fed and teaching materials too. So for those, I think we have a lot of things on the New York Fed's website which I think are helpful. But on your specific question, I think it's really, when historians or people like yourself want to, to talk to us, we're always happy to talk about, well, what materials could we try to find and help in getting that historical record. Thanks.
Yeah, it must be fascinating to be able to dig in there and see what Benjamin Strong and his colleagues were saying and thinking about during the Spanish flu.
I'll tell you, what's fascinating is how different the world was. Before I took this job, I had read this history of Benjamin Strong. By the way, everyone, the first what was then called governor of the New York Fed, and it's a very different job today. You don't take cruise ships across the Atlantic and spend a couple months in summer.
Yeah, he wasn't doing virtual talks either, I guess.
That's right.
Oh, well, we've got another student up with a question. Cynthia Peterman is here. Cynthia.
Hi, yes. Hi, President John Williams. Thank you for having me today. So economic, racial, and gender inequalities are some of the bigger issues today that can have a potential negative impact on economic growth. So what are some things the Fed is doing or might consider doing in the future to address some of these inequalities?
I completely agree with your point about this is a really important issue. It's an important issue for understanding the economy, and it's an important issue for our economy to reach its potential, which, when I think of maximum employment, you just think about what that means. It really means, individuals in the country achieving its economic potential. So in the New York Fed and my colleagues around the system are undertaking, various work similar to what we're doing. We've been very focused especially in the last several years, on inequality issues, both income inequality, wealth inequality, or inequality across different dimensions, and really understanding how that affects people's economic circumstances, looking at access to credit, looking at issues of access to healthcare during the pandemic, the different ability to get assistance during government programs during the pandemic programs. So we've been doing a lot of research and analysis about how that's been happening in our region and around the country. We've been doing a lot of more research and analysis, understanding inequality and its effects on the economy, obviously its effects on communities and the people, and how our policies themselves kind of interact with that. So this is a very high priority for me and the New York Fed, is to be expert at these issues, understanding them better. Often it's not our policies that are going to address some of these issues, but the analysis, the data, the research that we put out, I think it can be very influential in terms of helping people understand the issues, bring more data, more analysis to them, and so that policymakers in other areas of government, state government, local government, or federal government can use that information to formulate better policies. Obviously, we have a lot of efforts that we do as well in the community development and the Community Reinvestment Act work too, that's directly related to making sure that the financial system is supporting a vibrant, strong, healthy communities in our region around the country. So there's some direct work that we're very focused on in the community development sphere, but also there's this thought leadership and really providing data and analytics, and we do hear from a lot of groups who work on these areas that this is is really important for them, because we've got a lot of horsepower in terms of data and economic analysis that can really help people understand the issues and use to help hopefully come up with really good answers.
Thank you, Cynthia. We're running a little short on time. We have two more questions. We'll try to get to these before we break. I'd like to introduce Dr. Zimin Wang. She is an outstanding member of our finance department, and she's got a question for you.
Hi, President Williams. Thank you very much for sharing your valuable opinions with us. So I have questions on fintech. So the cryptocurrency market is growing exponentially, right? So what are the Federal Reserve's views on the crypto market and the regulation of it? And also, will the Federal Reserve issue a central bank digital currency soon?
Okay, you said we had 2 more hours to discuss this. Is that how much time we have? Okay. No, these are really important, super important issues. So first of all, I think whether it's cryptocurrencies or stablecoin or any of these uses of new technology, such as DLT or others, to really try to solve some of the oldest problems of money, payments, store of value, especially around cross-border payments and things like that. I mean, this is a really important time in terms of how technology and innovation maybe can unlock some of the problems that we've really struggled with in the past, especially with really high costs and lack of security in certain financial transactions, and the issues of the underbanked and unbanked in the United States. So I do think technology and innovation is really important. I also think that we need really good regulation, especially in the cryptocurrency and the stablecoin world. And the President's Working Group, interagency group, has put out a paper on that around stablecoin, and that's mostly in the world of the SEC and other agencies, not the Fed. But I do think that having a very good regulatory system to protect consumers, to protect investors, to protect us against risks of financial stability that could come out of these if they got too big. I think those are all important things to do. Now, on the CBDC question, that is the bright shiny object of central banking world today, is the central bank digital currency. So the Fed has just put out a paper on kind of talking about the technology. What are some of the policy pros and cons? I think this year and going into the future, this is going to be a big area of research, understanding the potential gains and costs and benefits of having a central bank digital currency, understanding the technology that would underlie it, how it would work, and also thinking about it more broad, really broadly, and not just in terms of payments between you and me when we're splitting a check for dinner or something, but also about wholesale payments and the international payments. So there's a lot of thinking and work that needs to go on. Fortunately, that is happening. It's happening at the Federal Reserve. There's been great work at my colleagues in Boston, working with MIT, thinking about the technology. My colleagues around the world through the Bank for International Settlements countries around the world in Asia and in the Americas and in Europe have been thinking hard and working hard on these technologies and thinking like, how would you do this? So, we aren't making any decisions right now in the United States, but we definitely are working very actively on the research, understanding the technology, understanding how the regulation of the other crypto and stable coins fits into this, and obviously thinking about from a public mission point of view, how can the payment system better serve the American people? How can it better serve our economy? So I don't have an answer for your last question today, but I will tell you this is a top priority as we think about through these issues over this year and into the future.
If we can just squeeze one more in here, we have Priyanka Ashanta here waiting to ask a quick question.
Hello, Dr. President Williams. Thank you for this opportunity. My question consists about climate finance risk. So climate change is an increasing threat to the global economy and financial stability. So I was wondering, what are some of the measures that the Federal Reserve is taking to ensure the finance stability related to climate finance risks?
So I think there's I know we're running low on time, so I think there's two broad categories I think about this issue, and it's a very important issue. So like everyone who's asked questions, these are really the important issues that we're dealing with. One is kind of in the standard, what we would call prudential oversight of financial institutions, of making sure that financial institutions who make loans or involved in activities that they understand the risks and including climate-related risks on their activities. So we want to make sure the banks that we supervise and the financial system that people understand, have good data analytics around that. So I think that's going to be a continued area of focus of making sure that banks, as always, have good risk management, good understanding of the risks they have, and that's a prudential concern about the safety and soundness of that. So I don't think that's a major change. It's just climate issues kind of or just another area of risk that add to all the other ones they had. To me, I think the new one is really understanding kind of some of the macroeconomic risks associated with climate, because climate isn't just going to hit one house or one business. It tends to hit whole regions. It can hit whole multi-country regions. And so thinking about macroeconomic risks and thinking about financial stability, as you said. And so thinking about our financial system as a whole, and thinking through, how could climate, either climate policies or climate events, because of the correlation across countries and industries, how that could pose risks to the financial system. So that's an area that we have people actively researching and working on. It's still early days on that because it's a relatively new area of study. But boy, a lot of economists now are writing their dissertations on these kind of issues. So it's a pretty exciting time also for research and thinking through climate risk to the economy, risk to the financial system. So that's an area that we're very focused on at the New York Fed. But it's really, let me just make clear why we're focused on it. What are our core missions? We have monetary policy, a supervision of major financial institutions. We are very involved in the payment system and very, very involved in financial stability. And I think that climate, just touches upon all of our core missions. It's not a separate mission. It's an important integral part of understanding how we're successful in our core missions, just like when we study trade, international trade or consumer theory or financial markets. We do that because we want to understand those things to do our work. And I see climate very much in the same way. These are amazingly great questions. I wish we had another hour. This is terrific.
John, I'd like to thank the students and our faculty for posing these questions. They're great. And thank you for taking time out to speak with all of us virtually. We hope we have the chance to host you in person at some point in the real near future.
Well, I look forward to that. I think I've already promised to do that. So I do look forward to doing that in the future. Thank you.
I'm going to reintroduce our colleague and friend, Adrian Franco, who's going to give us some closing remarks.
Thanks, Dean McSherry and President Williams. John, it has been a privilege to have you here at NJCU and at the Guarini Institute. For all other people, I worked with John for a few years at the New York Fed, and I was witnessed firsthand his accomplishments as a scholar, as a leader, as a policymaker. But I also saw his commitment to make an economy stronger for all and to advance the economic mobility of low and moderate income households. And that's what the Guarini Institute is doing, specifically with college students, looking for innovative ways and using technologies, economic development, international education to make sure that we have better opportunities for many non-traditional students. So we look forward to working with you in the future. We thank you for your time. I'm sure the students will be thrilled that you were here and will ask us to arrange another visit soon. So thank you so much for that. I also want to thank the Federal Reserve in general, because all the work that has been done convening thought leaders in workforce development, in education, really has opened the doors for many new approaches and new methods like we are using here at the Guarini and NJCU. So thanks for all that work in the community development team. And again, looking forward to talk to you soon. Want to thank also both the New York Fed team as well as the Guarini Institute team that came together and arranged this amazing conversation. And this is going to be recorded, going to be in our website, social media channel soon. So for anyone who is interested in listening again. And I think that's it. That's our time. Thank you so much, John, again, for your visit. Thanks, President Henderson, Dean McSherry, and everyone who joined us today. Have a good weekend.
Bye.